Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host Shafiq Morton. As always, it's great to be with you. In today's show, we're going to have a look at inflation and how it affects the cost of living. As we all know, in South Africa recently, our inflation rate has increased and it does seem as if prices will increase. In the show today, we'll have a look at how inflation and rising costs affects the average household, how it affects you as a rising professional, and how it affects you as a pensioner. In the second half of the show, we'll indicate and give you examples of mechanisms and instruments that can safeguard your investments and your savings against the monster of inflation. In studio with me today are Neville, Erambo and Hassan Motala from the Oasis team to help us through inflation. Neville, bonjour. Hassan, assalamu alaikum.
Wa alaikum salam.
Bonjour, Shafiq.
Hassan, when we see the inflation levels going up, as consumers we start to cringe because we see education costs going up, transport costs going up, food costs going up. In fact, everything goes up. How does this affect us in terms of our standards of living?
You know, when we talk about inflation, when we hear the word inflation, it's always viewed as a swear word in many cases.
Isn't it?
It is, definitely. I think you gotta be. What is inflation? Inflation, when you look at it from a simple terms, is basically the rise in the cost of goods. But remember, when we're looking at it, what we try and do, or what is done, is viewing inflation when you're looking at it from a basket of goods. So for example, today, as we stand here today, we've got 100 Rand. We can actually go into a supermarket and buy a certain basket of goods in there. However, in a few years' time, that same 100 Rand that we have today, taking into account, for example, you just highlighted earlier, the recent numbers on inflation that came out was 7% in South Africa. 7% then per annum, if it assumes that, we're going to have 7% inflation rate over the next couple of years, that 100 Rand that you're having today does not buy you the same level of goods. So essentially speaking, inflation is looking at the rise in the cost of goods over a period of time. And it's obviously across a variety of aspects. Now in South Africa, one of the key aspects we look at, or one of the main measures of inflation, is regarded as consumer price inflation, or CPI, as it's commonly known. What does it take into account? It takes into account a variety of goods and services. So from a goods perspective, be it on the food side, food is a big part of the inflation basket because, as you said, it affects our daily lives, whether we're eating bread, milk, meat, sugar, whatever it is, it's a big part of our lives and big part of, especially the lower to middle income, your big part of your consumption goes toward food. So that tends to be a bigger part of the CPI related measure. However, there are other big aspects towards it. For example, your accommodation. Many people, for example, and the measure you generally utilized is where rental, or you're renting a place. Remember, if you look at rental costs as well in South Africa, and especially in certain particular cities, rental costs have also moved up very significantly over the last number of years. That obviously impacts your ability and your standard of living, as you highlighted. So for example, as you said, you're earning a certain amount of income, but if your rental all of a sudden goes from 5,000 Rand a month to 8,000 to 10,000 Rand a month, that has a big impact in terms of, can you stay in the same place again? Because you're only earning a certain amount, your earnings are not increasing that much, and all of a sudden, if your rentals are up 50-60%, you may say, okay, well, I have to actually take a drop in the standard of accommodation that I'm staying in. So that's another part of inflation. So you've got firstly, your goods that we talked about, like your food items, then your services, which is the likes of your rentals, but very important aspect as well, which impacts everyone out there, is utility related services, particularly your electricity and your water and the like, but electricity in particular. And what we've seen obviously in the last number of years, with the impact of the load shedding and the like, we've had that impact coming through. Electricity prices in the last few years did move up very, very substantially. You've had double-digit type of increases for a number of years. Now, obviously, recently the regulators proposed about a 9% type of increase for this coming year. But on the back of where you've already had double-digit type of increases. Now that affects, again, a wide variety of people in terms of your electricity costs. Either you're going to say, okay, hold on, I can't put on my heater now for the whole night. We need to be doing that all the time. We need to be actually conservative in terms of conserving energy, conserving water and the like, because we do have challenges on the water side. You've got the droughts that we've had an impact. It's important to conserve, and obviously it has a related impact on your costs. But electricity-wise, with electricity increasing at double digits in the last few years and 9% expected this year, if you don't conserve, you also have an impact in terms of your electricity increases going forward. So it's the basket of goods and services which essentially defines what is inflation, and in South Africa what we refer to as CPI.
Neville, what is the essential difference between inflation and what we understand as the cost of living? And the second part of the question, why is it important to safeguard against inflation?
This is an important question that I get asked all the time. It might seem that inflation is the same like cost of living, but these are two different concepts, and I'll explain why. As Hassan mentioned earlier on, inflation is the big picture. As the price of goods and services increases, it reduces the purchasing power of the rand. This basically means that the same basket of goods, the same quantity of goods, that you will not be able to buy the same quantity of goods today than what you bought yesterday, or say 1 year ago, or even 5 years ago. Cost of living is a more focused picture. It influences your standard of living or your quality of life. Take, for example, it is all about the choices you make on food, accommodation, transportation, healthcare, and even taxes. Cost of living, it is usually used to compare lives in different areas in South Africa and also the world. Say you are an accountant now and you live in Johannesburg. You earn 800,000 rand per annum living in Johannesburg. You can maintain the same standard of living with 3/4 of that salary living in East London. This is because the cost of living in Johannesburg is greater than that of East London. Protecting against inflation is very, very important. It's imperative because we need to maintain, we need to keep pace. You need to keep pace with the cost of living. And inflation, keeping pace with the cost of living means that inflation can hurt your money, your salary over time. And if this happens, then you will not be able to make choices to buy the kinds of goods that you want at the long run. And if your income is eventually eroded, it means that you'll be in a position whereby you need to substitute for cheaper items. If you don't substitute for cheaper items, Hassan mentioned, then you can only reduce your basket items or your buying list. Otherwise, you need to look for extra or supplementary income. In recent years in South Africa, inflation has been between 5 and 7%. This increase every year has greatly affected our household income. And Hassan again mentioned, he highlighted that as the price of goods, consumables, and foods, as they go up, you cannot be able to purchase, you cannot buy at the same price, if I should say, what you bought 1 year ago. Say, for example, when I first got into South Africa 5 years ago, the price of a loaf of bread costed between 5 and 6 rand. Now, depending on where you shop for your bread, you can pay anything between 10 and 15 rand. And come to think about it, Shafiq, it is more than 100% increase, meaning that if your income is not keeping pace with inflation, sooner or later you'll be in a position whereby you need to dig deeper into your pocket in order to buy a loaf of bread. This is just a simple example. The point I'm trying to make here, Shafiq, is that inflation is a concern, and it's a very big concern, and it erodes your quality of life, and that is what we need to protect against. You cannot be in a position whereby you need to choose between your basic needs. You should be able to fetch food for yourself, to provide accommodation for yourself, transportation, education for the children, and even health care, without you compromising these choices. And if your income is going to keep pace with inflation, if you make your income keep pace with inflation, eventually, or even exceeds inflation, eventually you'll be in a position whereby you can make this decision without compromising your lifestyle, and you can better control your quality of life.
Hassan, let's start off with you in the second part of the show. Very simple question. How do I protect myself against this monster called inflation?
We need to make sure that whatever we're placing our investments in, that we are putting it in the right investments that protects ourselves over the longer term. So for example, many people over the years, historically, going back, I'm talking now back many years back and the like, many people had the habits to obviously keep their money under the mattress and keep it there, and because it was viewed as a very protective place. You're leaving it either in a safety deposit box or leaving it in a mattress and knowing, okay, I've put my 1,000 Rand in there. I know that in 2 years' time or 3 years' time, I know that thing's still going to be under the mattress, or it's still going to be in that safety deposit box. I've protected it. You haven't protected against inflation. And there's a variety of options to make sure that we're protecting against that. Now, one of the concerns, obviously, that I will highlight firstly the different type of assets that you can place in. So for example, equities. Equities is one form of asset class, be it South African equities or global equities, that has shown over time it has been a fantastic protector against inflation. If you look at the South African equity market or South African funds, for example, the Crescent equity fund, over its period of time, has delivered fantastic returns relative to inflation. In fact, it's been a multiple of inflation over a period of time, over the last 17 years or so. But even on the global front, if you look at the global equity fund or the global markets, have also, particularly global equity fund, has delivered fantastic returns against inflation over that period of time. So equities has been a phenomenal protector of inflation over the long term. Now, one of the concerns obviously of investors tends to be is that obviously that you do find volatility in equity markets. That tends to happen. For example, we had the financial crisis a few years back. We've had the events of December recently, which also resulted in increased volatility. So you do have events and times where you will have financial volatility in financial markets. However, when you're comparing inflation versus volatility, that basically inflation is your biggest risk over long term. We spent a lot of time in the first half of the program highlighting the concerns around. Over time, inflation is an investor's biggest risk and the biggest area of focus. Volatility, while in the shorter term, it does raise concern and it's an issue, over time, it tends to ease off. Therefore, while investing in equities, you do concern of short-term volatility, over the long term, it addresses the issue of inflation. Another asset class which is important is property. Property, be it investing in property, listed property companies on the stock exchange, or investing in fact in physical property, be it your residential property. Your residential property is always a good investment, because you and your family are going to live in there over many, many years. And we've seen in South Africa as well, if you invested 10, 15 years ago in a residential property, you've done very well. Residential property values have moved up also very significantly, has outperformed inflation over a period of time as well. So property, be it the listed property companies or investing in physical property like residential property, your own actually tends to be also a good longer term investment, a hedge against inflation. So those two particularly tends to be good hedges against inflation over the long term. Now, I'll sort of delve on it a little bit later on, just in terms of balance funds. But these essentially, your equity and property end up being the big building blocks around your balance funds and help investors over the long term. So I think the key essentially, Shafiq, is investing and making sure that you're investing in assets such as equity and property, be it as part of a balance fund range, or be it individually that you're investing in those assets. You need to make sure that they do make up a reasonable proportion of your portfolio of assets, because they will ensure protection against inflation over the long term.
Neville, as a young professional, how would you protect yourself against inflation, very briefly?
Very briefly, as a young professional, they are in a position to benefit from the following 4 key points. They can take full advantage of more than any other age group. Firstly, they have a very huge appetite for risk. It means they can invest in risky portfolios such as equity, but should they stay long, over the long term, the value gain would outweigh the short-term losses. Secondly, they can take full advantage of compounding. Compounding basically means it's growth on growth. If you save money today, you have growth on the growth, and so on and so forth. Now, say you are 23 years or 24 years old and you want to retire when you are 65 years. It means if you stay in regular employment, you will be in employment for about 40 years. If you invest 1,000 Rand, that averages 10% in 40 years, it means at retirement you are going to get an income, your money must have grown to 6.2 million Rand. And this is the power of compounding, and it should not be underestimated by young professionals thinking that they still have time. Procrastination is a theft of time, they say. Let's go a little bit further. Let's say you delay by 10 years when you are 33 years old, and all scenarios the same. You invest 1,000 Rand or you save 1,000 Rand and it averages 10%, you can only come out with 2.2 million Rand. Now, this is a very, very big difference, a difference of 4 million Rand. This takes me to my third point, time. Time is of the essence. Time is what the young professional have on their side. With just a delay of 10 years, they get 4 million less in their retirement income. That's such a substantial amount. And you should put all your impulse purchases on the back burner in favor of a savings when you're starting out. Meaning, as a young professional, you want to purchase cars, the most expensive houses, travel to the best destination. You focus on your wants rather than focusing on what needs to be done first. So in that case, if you are focusing on what needs to be done first, you can have money at the long run. You may have some money, more money to put aside as you get older, but you might not have the time. And to me, this is very, very critical, because the little money that you keep today, they are going to mean a lot in the future. And as soon as finally, as a young professional, as soon as you start working, if you receive your first paycheck, then you need to start saving. In doing that, you are going to keep pace with inflation, if not exceed inflation, and you are going to have better control in the quality of your lifestyles and the decision that you make.
How different is the situation, Neville, with pensioners?
Yeah, with pension, let's assume that you are that worker that really saved well when you started working and you wanted to take advantage in your retirement age. It's always a good idea to adjust your retirement income in line with inflation. But most at times, this adjustment, this increase is a bit lower than inflation itself. And if you are that person that depends on a fixed income, inflation has a profound impact on your pension, on your income. And most at times, we underestimate it. If you take an inflation of 6%, in 10 years' time, then your income will almost be half. And to ensure that you maintain this standard and this quality of living, there are some key points you need to take into consideration. You might not have factored in medical expense or special care, which is very important. And even though you're retired, your retirement funds, your pension fund needs to still be invested in a product that is going to keep pace with inflation. You don't want to, again, be in that position where you are going to be struggling with your basic needs. And as such, you can do this by investing in the Oasis Crescent pension annuity or the Oasis pension annuity. These products are designed to protect you against inflation, protect your income, and over the long term, give you real growth and value addition. It's important to note you can have lump sum, cash lump sum, maybe the 1/3 that you took out. Before spending it, you need to take into consideration, you need to have a long-term view. And having a long-term view is that you have to think wisely. You can have another good 20 to 30 years to live after your retirement. And should you not have sufficiently saved or have good support, then you find that the experience that you face in retirement will be an uncomfortable and a very, very sad one. So, and if this experience is going to be uncomfortable and sad, the only message that I can give you, if that is what you take home, is that you need to save, save, and save, because everyone deserves a dignity and a comfortable life when they retire. And if you save, save, and save, continue to save and start early, it means that you are going to have decision over your lifetime, and you're going to have a better control, and the little money that you put away today, they are going to mean a lot one day.
Absolutely. Now, Hassan, you mentioned previously ways that a person can beat inflation. You spoke about property, you spoke about equity, but what about balanced funds?
I think, if you look at the balanced funds, it's the perfect solution in terms of saving towards retirement or saving towards protecting against inflation. Neville talked about earlier in terms of the professional. In our balanced fund range, we've got, for example, the Oasis Crescent Balanced High Equity Fund of Funds. So that has a higher exposure towards equity within the balanced fund. That is perfect for the professional out there. You're starting out in a career, you can afford to have a higher exposure in terms of exposure to, as you said, slightly higher riskier assets such as equity and property, which is more your medium risk. If you look at the high equity balanced fund over time, has delivered fantastic returns relative to inflation. So that's an important aspect. I think for professionals out there, so you're 20 onwards to up to 40, 45, that is a perfect fund in terms of saving over the long term and ensuring that you're getting adequate exposure towards inflation hedging assets such as equity and property. The other one to highlight is obviously, Neville touched on, which was obviously the pensioners. The pensioners obviously now somebody who's obviously now in that focus where they've retired and wanting to make sure that whatever they do have, they can make sure that it lasts them for a long time to ensure that they have an adequate lifestyle and living during their retirement years. Now, the Oasis Crescent Balanced Stable Fund of Fund is perfect for that. Or for example, if you obviously want to draw an annuity, then we've got obviously the living annuity or the pension annuities to cater for that. But the Crescent Balanced Stable Fund of Fund, which is essentially a low equity balance fund, ensures that you have still appropriate exposure towards equity, appropriate exposure towards property, but at the same time making sure that you have a sufficient amount of income in the portfolio to give you that stability. So you're protecting against inflation, while at the same time your volatility in that fund is very, very low. I mean, for example, in that fund, we've done the numbers and we've seen that in the market, when the markets were down, that fund actually was very, very stable during volatile markets. So that would be the perfect solution for the pensioners out there.
And to our special guest today, Neville Erambo, Hassan Motala, thanks for chatting about inflation. And if we take anything away from today's show, inflation does erode your buying power. And I think the advice is save early, invest early, and you will beat inflation. And that concludes today's edition of Focus on Finance. Should you wish to tune into this or any other show, you can log into the Oasis Crescent YouTube channel. Should you wish to contact Oasis, you can call 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm your host, Shafiq Morton. Assalamu alaikum wa rahmatullah.